The conflict in Ukraine has pushed gas prices to more than $5 a gallon in parts of the US. Food prices are rising at the fastest pace in years, and housing costs are rising by as much as 30%. Everywhere you look, there are signs that inflation is not going away. The Federal Reserve has said it plans to raise US interest rates to slow inflation, but that cure has a cost. The last time inflation was this high, the Fed raised rates by so much that it put the country into a recession. Will we see a repeat of that today? I'm going to explain how the Fed could take the US into a recession, why that could be a good thing, and why the Fed's next steps are so important to our economy's future. Let's get into it. The Federal Reserve was created to provide price stability for the United States. That means controlling inflation is its first and primary goal. Even though Fed leaders have said they expect to raise interest rates multiple times this year, there is concern that the Fed is already too far behind. That's because once consumers and businesses begin to expect prices to rise consistently, they change their behavior accordingly. Economists are worried that this shift has already happened, and that even after supply chain bottlenecks and labor shortage issues are resolved, inflation expectations will remain high. That would cause businesses to keep raising their prices, and workers to continue to demand higher wages. What's been shown to rein in spiraling price increases historically is higher interest rates. Higher rates make consumers want to save rather than spend, and businesses hold off on expanding. That pullback can slow the economy down, which also slows down the rate at which prices are increasing. But if inflation remains stubbornly high, the Fed may have to raise rates so much that the economy stops growing altogether and starts shrinking. When that happens, jobs are lost, wages fall, and the stock market generally turns red. This sounds bad, and it is, but economists generally agree that it's better than the alternative, which is allowing prices to continue rising at a fast pace. That's because inflation, unchecked, increases to the point that a country's currency loses so much value that it becomes virtually worthless. We've seen this happen in places like Germany and Zimbabwe, and more recently in Venezuela. The cost for everything jumps. Companies can't buy materials or basic supplies, and workers lose their jobs. When we last saw inflation as high as it is now, then Fed Chairman Paul Volcker had interest rates set at more than 14%, and that was down from 19% just a few months earlier. That eventually ground inflation back to a more manageable level, but it also brought about a painful recession, tanked the stock market, and sent US consumer sentiment to its lowest point on record. The question many in the market are starting to ask themselves is, will Fed Chair Jerome Powell be willing to do the same thing today, if necessary? There are worries that the answer is no, because of what we've seen from the chairman in recent history. Powell said for about a year that the current inflation we're seeing would be transitory and would recede on its own, before retiring the term in November and committing to take action. Investors also remember how Powell reversed course on raising interest rates in 2019, after the stock market started to buckle. Interest rates had reached just under 2.5% at that point, having been near zero for more than a decade. Then there was the unprecedented action Powell and the Fed took in March 2020 that sent stocks soaring even as the US economy had its worst quarter in history. That gave some, like Allianz chief economic advisor Mohamed El-Erian, the impression that this Fed was doing more for the market than the real economy. So many are watching every word from Powell and the Fed to see if the policymakers there are committed to doing whatever it takes to tame inflation. The Fed will have to walk a tightrope going forward. If inflation does ultimately cool later in the year, as they are again predicting, raising rates too fast could cause a recession unnecessarily. But if they raise rates too slowly, inflation could spike and get out of control, causing even greater pain. With so much uncertainty in the world, the only thing we know for sure is that policymakers will need to be on their A game. If you enjoyed this video, I want you to hit that like button and subscribe to keep up with my latest videos on markets. I want you to be like Yo Gotti, who told us in 2020, I'm a real hustler, I'm recession proof, I know how to make the paper and stack it too. I'll see you next time.